on the issues that we're going to discuss right now. What were the main issues in front of the court? So those are the facts. Stacy?
3 of them.
So one of the main issues was the approval required, and was it given? I think that they determined that approval wasn't required because they weren't substantial changes. Approval wasn't required per the agreement. It was only if there were certain things required.
That's right.
All right. And so, and then there's the issue of, so that was a factual question, you're right. Was there a breach of contract by Anthony? Was there a breach of contractual duty by HBC to proceed expeditiously? That was Anthony's claim. And then there was there a breach of the implied covenant of good faith and fair dealing? And that's really one of the things that we're focusing this discussion on. What did the trial court say on those issues? First, breach of contract by Anthony.
That he didn't have the right to say that it wasn't approved. And so he did.
Yeah,
All right.
he was unreasonable in withholding his consent.
Exactly. And so Anthony had the right to disapprove changes in the basic plan only to the extent that such changes had materially adverse effects on one of the review conditions. Those changes embodied in the BRA master plan did not have a material adverse effect on those conditions, and therefore Anthony had no right to disapprove them. And Anthony's approval of the BRA master plan had been unreasonably withheld and in violation of his contractual duty. All right, second issue. Did HBC fail to proceed expeditiously with the development? What did the court say? No. But for that big red flag letter, HBC would have begun construction of the hotel by the outside closing date, and therefore that letter had a profound effect on the transaction and their ability to perform. And as a practical matter, HBC couldn't perform its obligations after Anthony sent that letter. It raised the whole issue of, do you have a deal from the permitting standpoint, from the standpoint of financiers that they were both kind of jointly courting? That was a total deal killer, right? Breach of the implied covenant of good faith and fair dealing by one or both of the parties.
So how'd they rule here? Yes, exactly.
Okay. So yes on the part of Anthony.
Right.
And then this is sort of an important legal principle when it comes to contracts. Every contract implies good faith and fair dealing between the parties to it. The implied covenant of good faith and fair dealing provides that neither party shall do anything that will have the effect of destroying or injuring the right of the other party to receive the fruits of the contract.
Right.
That's the idea behind this implied covenant of good faith and fair dealing.
Yeah,
That's the idea.
It's really important to keep this in mind whenever you're doing things, because we do have such freedom of contract here in the States, and we do these contracts where we waive duties, but this is always there no matter what you write. And so you need to be really thoughtful, even though Anthony's was using rights that it had in the agreement, it was doing so using bad faith, and that's where it got in trouble.
The development advisor warned that Anthony's belief that the agreements did not represent current market value would affect how Anthony dealt with HBC, right? And Anthony's purported disapproval of the master plan destroyed or injured HBC's rights to receive the fruits of the contract and thus violated the implied covenant. Damages. Were there damages? Right. $42.6 million. And you know what? In 1990, 25 years ago, that was real money, folks. Right? That was real money. All right. So then both parties ask for an appeal. It goes right up from the trial court, jumps the appeals court, goes right up to the top court in Massachusetts. And what did the SJC say? Yeah, they affirmed. Okay. And then they give us a little color in terms of trying to make a point of why they took this on direct appellate review. Anthony's asked us to hold that in contracts between sophisticated business people, no covenant of good faith and fair dealing is implied. Why? Because we're all so smart. And the court says we decline so to hold. No, that's not right. Anthony further maintains that because the trial judge did not find bad faith, that therefore he did not violate the implied covenant of good faith and fair dealing. And the court says, no. Just because the trial judge didn't find bad faith doesn't mean that you still didn't violate it.
Good faith, right.
And then there's a little bit of Massachusetts law. This is the kind of consumer protection statute called Chapter 93A, which makes unlawful any unfair acts or practices in the conduct of trade or double or triple damages, and costs and attorney's fees. And Anthony's knowing use of a pretext to coerce HBC into paying Anthony more money establishes willfulness as a matter of law. So you have to knowingly and willfully, can I go back? So attaches if a party acted knowingly or willfully in violation of the act, and the court says that the knowing use of a pretext requires that willfulness, or excuse me,
Establishes willfulness.
establishes willfulness as a matter of law. And then the court goes on to say we recognize there may be cases where an act might be unfair if practiced upon a commercial innocent. I'm not sure what that is, but it sounds like someone with much less sophistication than you all have, and yet would be common practice between two people engaged in business. In such circumstances, a claimant would have to show greater rascality than would a less sophisticated party.
That's a good word, isn't it?
Anthony's conduct, however, more than meets the standard for an unfair or deceptive act or practice, even taking into account that both parties to the transaction were sophisticated. So the reason we gave you this case is you're going to be talking about granting your counterparty approval rights, right? And this is an excellent example of when you get those rights and all of a sudden you try to use them for something different. And Anthony lost everything. Anthony, he lost the entire Fanpeer site, right? And in some respects, it's funny, Jennifer, you said get your attorneys to write a letter that says, pursuant to, Article 8.2 of the JV agreement, our consent is given. This happened in the early 90s. This went to trial. Does anyone, well, how old are you guys? Okay, yeah. Rick remembers. The early 90s in Boston was the absolute worst real estate recession probably ever, since maybe the mid 70s, but it was worse than that. So that land was looking in the early 90s like it could never be developed, and this judgment came down for 40. So the irony here is the fact that this did go to trial, and Anthony's behavior was so bad, allowed HBC to actually get a windfall, get the land for free. Yep.
Crazy.
And then they turned around and sold it to the courthouse for $35 million for the federal courthouse.
Oh, is that right?
Yeah, they did just fine. Okay. Hey, we have all of these programs represented here in the room, and you might not know this. Well, how about this? What did you think of the development advisor? Smart young development advisor. Because you could be a smart young development advisor, right? All of you could get out and become a smart young development advisor. She actually ran the development company for Anthony. President of it, right out of school. Great job. What'd you think of the development advisor? Is that the sort of job you might like? It's okay, you can talk. Although we are being filmed and streamed around the world, but whatever. No thoughts on the development advisor, the advice, nothing? Pardon, Rich?
Exactly.
All right. So the development advisor got a degree from one of those programs. Which program? All right. So sadly, folks, we're famous, and we need to work on that, right? Unfortunately, it was a graduate from the very first class of our program. Just wanted to mention that. I don't know if just wanted to mention. All right. So, all right. So this is where we took a little 15-minute digression, but we are now back.
All right, so duties.
All right. So what duties do we have to each other? Right, Jennifer, what duties do we have?
Good faith and fair dealing.
We're forming a Delaware LLC, so we can negotiate that. Hey, all right.
You forgot my first rule.
What's that?
The first rule of doing a JV, okay, after you decide you're going to do it, is Delaware.
Delaware, all right. And, all right.
Not New York.
Right.
Not Massachusetts.
Well, certainly not Massachusetts. And why, Counselor, why is that?
Why? Because it's got a very, very well-developed law, a sophisticated bar, and a statute that's kept up to date.
All right, sophisticated.
That's a nice way of saying that they don't have these Picocto rules about fiduciary duties between partners as they do in Massachusetts and New York.
Well, they do if you don't get rid of it.
They do.
Yeah,
They do.
The Delaware law is very clear. You can waive everything except for good faith and fair
Correct.
dealing.
And we gave you section 181101, right?
There's a New York case from the 20s that talks about the fiduciary relationship.
And what case would that be? Minard v. Salmon? Justice who? Cardozo. Punctilio. There you go. And I still don't know what the hell that means. I have no idea what that means.
That's the way Cardozo wrote.
But it sounds very important, so we're not going to violate that. All right, so, and we gave you that excerpt from the Delaware Revised Uniform Limited Liability Company Act, and it talked about just what Lee is saying. Hey, look, if the first thing we can do, if it's in Delaware, we can just look each other in the eye and say, you know what? We don't owe any duty of any kind to each other except what? Good faith and fair dealing. And that Fanpier case is what that means, or it's one example of what that means. Because when you just read those words, good faith and fair dealing, I don't know that I know what that means. But you put a set of facts around it, and the courts have given us at least one good example in terms of behavior.
Yeah, but in Delaware, that's a very much lower standard than the one that they applied in Massachusetts.
Okay.
But I also think these facts were so egregious.
They were egregious.
It was so obvious there was a holdup.
Right.
All right.
I think that,
So for next year, I have to ask a question. I wanted to, but I remember 3 years ago, I was going back and forth with Lee, and I'm like, hey, I want to do something on partnership duty. He's like, no, let's not spend time on that. I'm like, all right. So we gave you a kind of an excerpt of the I edited it quite heavily, the Fanpier case, the Pier 4 case, but the Gatz case is now would you have wanted another case on what the state of the? It's not even the The appeals court had this extensive ruling that tried to summarize Delaware law, and it went up to the Delaware Supreme, the highest court in Delaware, and they just said, you know what, you could have answered the question about what the duty is just by looking at the contracts. You didn't have to pontificate about what the default law, what the law is for a default duty in Delaware. Would you guys have wanted to read another case if it was like another 15 pages? If you don't, just tell me. No way? Okay.
Well, because this one's so egregious and that one is so egregious. But if there was one where it was like less of a clear line, then that might be helpful. But where they're both so egregious and it's clear that the one
Okay.
is in bad faith.
All right. That's good. What? No, I know. No, I know. Hey, look, at this point I'm taking whatever feedback I can get from you guys. So, but, all right, so would you have had any more interest in that? If the answer is no, just tell me. Okay, it's no. All right. So that was easy. All right. So we're forming a Delaware LLC so we can negotiate that. And you're the one, Jennifer, with all the money and all the lawyers.
That's right. That's why we can negotiate.
Perfect. All right. So what's fair when it comes to decision making and control? Is the term managing member really a misnomer? Right? Should it be? Where do you draw the line on what's a major or important decision that requires investor member approval? You're going to be talking quite a bit about that.
Yeah.
The governance structure of your venture. It's what you live with day to day. And what are fair and practical dispute resolution mechanisms when disputes over important issues occur? And that's a nice segue to talking about transfers or exits. All right? All right, Jennifer, at some point I may want or need to transfer my interest in the venture or assign some or all of my promote. What's a promote? What's a, okay. Good.
The outsized return that the sponsor gets after the preferred return is paid.
Perfect. Okay. And the promote is sort of a dollar-denominated term. A promote is money, and the way you get that extra money, that outsized, the disproportionate amount of money relative to your capital put in, is you get a promoted profits interest, and that's the distribution provision or the waterfall where we're going to end up. Okay.
Yeah, wait a minute.
Well,
Wait.
hold on. There we go. I got it. I'm right-handed, not
Yeah,
left-handed. Man.
we are giving you a promoted interest because we're investing in you. We want you to stay aligned with maximizing the financial returns of the project. We want you to keep that incentive by holding on to that promote.
Okay.
So we need approval rights over any transferee of your interest.
Okay. So, and I get the same. I get the same deal, right?
No, not exactly. We're a financial institution
Oh,
and we're not
geez.
really set up like that. And plus, you wouldn't care who I transferred to. Whoever it was would be well capitalized.
All right. So in light of what we just talked about in terms of governance, I shouldn't care about who my new partner might be. Suppose it's like my biggest competitor or an enemy, someone I'm in litigation with.
Well, we try not to do that.
Oh, that's terrific. Okay. So I think we need to try harder to figure out how we can both monetize the value we're going to create through this venture. And I think that's a fair, we both need to think about how we're going to get out and how we're going to actually make the money and keep it. How about this? When I want to sell my interest in the venture, I'll let you make me an offer.
You'll give me a price?
Yeah, I was thinking you just make me an offer.
And what if I don't want to buy your interest?
Yeah, then you're going to need to let me sell it. I didn't get into this deal not to be able to get out of it.
Yeah, I understand.
Maybe we just sell the property.
Well, the problem with that is I have liabilities I need to fund with income from this asset, so I don't want it sold until it's time for me to sell it.
Well, look, I need the right to sell my interest.
Oh, understood. We'll figure it out.
All right. All right, distributions. All right. This is the part that everyone likes to negotiate. I love this deal. We're going to make a ton of money. You got to be thrilled that I brought this to you.
Well, aren't you glad I'm putting up 90% of the money?
Yeah, I know that. You know I need to be properly incentivized to maximize the profitability of this venture. I need to get a big promote if things go really well.
If things go really well, I think you deserve a promoted interest. I'm willing to trade some profitability on the upside in return for some risk management on the downside. And we're developing condos too. When does that mean you get your promote before we get all our money back?
Look, if we're rolling in the dough, who cares? Right?
But if things don't go well after we sell the condos, I could be left not getting my money back or not hitting the threshold that I want to get, and you have all that promote in your pocket.
Okay.
Oh, and the winds of profit aren't at our back.
Hey, we're partners. Right?
We're both going to get all our capital back with a minimum return before you get the promote, right? We also need to talk about who establishes a level of reserves before any promote goes out,
All right.
or distributions go out.
So what's fair when it comes to distributions? And by what standard? The last deal you and your boss negotiated, is that what's fair? What the panel junkies said at the last conference you attended, all those people, the same people are up there on the panels at every single conference, just talking to each other, not caring if there are 2 people in the room or 2,000, right? Those are the panel junkies. Or how the broader capital markets price expected risk and return, or some mix. You know what? I want to focus on that. All right, so this is where, if you were lucky, we would introduce David Geltner. But you're not lucky. David is actually in Amsterdam this morning. A PhD student is defending his thesis, and so you get the Booby Prize, which is me. So I'm going to pretend I'm David Geltner, and we're going to talk about how the broader capital markets price expected risk and return. All right. So what's that a picture of? Well, hold on. What was that chippy little remark? All right, so these are unlevered project cash flows. All right? So that's kind of a very crude depiction. And, we can sort of break them out in terms of their components. These are obviously the condos that we build and sell early on. Then we've got, this is the NOI for our commercial, office and retail, and then we've got our sales price when we sell the commercial condo at the end. And we got a little bit of interest earnings in the pro forma. So our total development cost is $104 million. We've got $164 million of total revenues that'll come in the door, unlevered IRR of 11.2%. All right, and let's take a look at what our levered cash flows would be like. First thing is we are going to introduce debt service on the commercial condo. That's going to take away obviously some of that NOI. We're also going to have to pay off that loan when we sell the commercial condo, and we're going to have to pay off the construction loan portion related to the condos as we sell out the condos. So when we offset our, with these basic debt service payments, we offset our unlevered cash flows, we get levered cash flows that look like that. And our levered cash flows are $90 million. Our equity investment is about $42 million, and our levered IRR is 18%. All right, so here are our levered cash flows. And what's that a picture of? Okay, what type of distribution? What does that look like? Yeah, pro rata, right? 90-10 pro rata, pari passu. You like that? No, you don't like it. Okay, all right. Just asking. Okay. It's fair? Is it fair? No. All right, just asking. Just asking. What's that a picture of? That kind of looks like the developer doesn't get anything to the bitter end, right? So that would be an 18% pref to the investor member. You'd both get 18%, but everything would go to the investor member first. You like that? Yes. Okay. All right. Okay. That's just kind of very hypothetical. And what's that a picture of? That's a picture of our splits based on the language in the form agreement. Okay, where we have condo proceeds here, and we have the sale of the commercial unit there, and we've got the managing member at about 28% and the investor member at about 16 or 17. All right, and so let's kind of maybe dig into that just a little bit. And what we want to talk about is a framework that David Geltner has developed that some others just presented at ULI in San Francisco last month, to try to help investors figure out whether or not the negotiated distribution provision is fair relative to the two parties, okay? And so we have to kind of, and this is where Paul Schwartz starts squirming in his chair because I use the word fair. But from a capital market standpoint, of risk and return, is there a way that we can put a lens over what you negotiate, the distribution provision, and have a framework to determine if one party is doing better than the other based on a range of expected outcomes? So we gave you as part of your readings David's chapter 15.3, okay? And what we thought we'd do is maybe just sort of apply that thinking to our fact set and see what we get. So here's our project, our hypothetical that we'll be spending the entire day kind of thinking about, at least in the back of our mind. Our $104 million project, and we're going to lever that up with a $62 million mini-perm loan. Here are our major sort of assumptions on the condos and the commercial space, on the revenue side, and then on the disposition side for the commercial space, a 7% cap rate. These are what the cash flows look like on an unlevered basis. There's another picture of them. And that gives us an unlevered IRR of 11.2%. And we can also break that out based on the development costs attributable to the condos and the remaining commercial portion. And it's about a 16.4% unlevered return on the condos and about a 10% unlevered return on the commercial space. Is that good? All right, so if it wasn't good, we would probably just stop here, right? So is it good? Because you want to keep going. All right. So what we did is it's probably like 3 years ago, got on the phone, David and I did with Casey Wald, who at the time was at Tishman Speyer, and Chuck Bird from Bentall Kennedy, and Rob Gifford from AIG Global Real Estate, and Peter Spelios from Related Beal. And we said, look, let's talk about what kind of, in a good market, somewhere in our kind of world of, we don't identify where our hypotheticals are, what would we look at for unlevered returns? And they all got comfortable with something like this. So at the time, this was good, okay? It was okay. And so that's our unlevered returns. Our levered, we put that 60% mini-perm in, and the condos now go up to about 30% on a levered basis with 60% debt in the capital structure. And our commercial is at about 15. Okay, so, all right. So everyone was kind of cool with that 3 years ago. Okay. So, and we've talked about our the structure. Then we asked, and we said, so give us an example of what, this was 3 years ago, what would be the structure of a waterfall or a distribution provision that you would sort of, both sides might be comfortable with. And we ended up with sort of a 90-10 deal, pro rata pari passu to the first hurdle at 10%, then 80-20 after that, except there would be a disproportionate allocation of cost overruns to the managing member. And why might that be? They're in charge, right? Right? They're the boots on the ground. They're in charge. But then there would be, if the profitability was there, that disproportionate additional capital contribution would be repaid. That's the catch-up. And then it would, the next hurdle would be at 15% and 13%, and then at 15%, and the splits would be 70-30 and 60-40 respectively. The condo sales would be treated as capital proceeds, not cash flow. And so we ended up with kind of something like that. That's what those JV investor rock stars thought was, fair. Here's another way of looking at it, 10% pro rata pari passu, right, based on the 90-10 deal. Then up to 13%, it's 80-20, except we've got the disproportionate allocation of cost overruns. And if the profitability notwithstanding any of that, exceeds 13%, then it's 70-30, and it ends up 60-40. Okay. So this is our picture of our levered cash flows, and this is what we think is going to happen, and we get a result of about 29% for the manager, and again about 16 or 17% for the investor member. And the question is that fair? Now, we're not talking, do these cash flows include the development fee? No. So the manager is getting twice what the investor member is, plus $2.8 million. I'm just asking your opinion. Is that fair? So what we're going to do now is maybe look at a framework that would help you answer that question. Is that fair? Okay? And so we're going to ground ourselves in a little bit of academics here. We're going to use capital market theory to provide a framework and a starting point. We've all seen this. On our vertical or y-axis, we have price, we have quantity on the x-axis, the horizontal axis, and what brings the market to equilibrium is the market price. And in this case, the market price provides for the opportunity cost of trading. And we're talking about a capital market where we're trading money. And so this opportunity cost we're talking about is a discount rate, that minimum required rate of return you'd need based on the risk associated with collecting the expected future cash flows. So what is a capital market? A market that trades risk and investment assets. The capital market determines the market price of risk in terms of the going in expected return risk premium, and that's over treasuries. So the key thing here is the capital market determines the market price of risk in terms of required returns, right? In terms of discount rates, this is our sort of basic diagram, capital markets diagram, where we start with the risk-free rate, and as investment assets are perceived to have increasing amounts of risk, the capital markets will require that they offer investors an increasing risk premium or return premium in order to compensate the investor for accepting or bearing that additional investment risk. All right, so the capital market determines the price of risk as the slope of that security market line. So the price of risk is, the capital markets are determining the slope of that line that compensates investors for increasing risk. Any asset or claim priced at fair market value must lie on the security market line, right? And so here we have two different assets. One, asset A has a certain risk profile and has a certain associated return premium or risk premium, and it's obviously less risky and therefore warrants a lower return premium than the riskier asset B. For any two claims, the ratio of the going-in expected return premium must equal the ratio of the going-in expected risks. So there's a rational relationship between what the expected return is based on the expected risk, right? And they're going to have the same ratio. Both assets are going to be on that line. All right, if a development project is priced at fair market value, this is the project right here in the middle, then it's going to lie on the line. Now, if the deal that we're talking about is fairly priced in the capital market, then that means that the debt markets are very efficient, right? If anything is going to be on the security market line, it's going to be the debt, all right? So, but if the project is fairly priced in the capital markets, debt is almost always fairly priced because the market's so efficient, and therefore, if the project and the debt are both on the security market line, then the levered JV equity position must be also, okay? In that case, both partners' claims must have the same ratio of return to risk in order for them to both lie on that line. So this is the fundamental sort of capital markets framework. And that ratio of return to risk is what's called the Traynor ratio. That's the so-called Traynor ratio. If the levered JV entity lies on the security market line, that's up here, right? Then the Traynor ratios of each partner's claims should be equal. Here's an example. Otherwise, one with the lower Traynor ratio will lie below the line, right? And that might be B here. And they won't be receiving a fair expected return given the amount of expected rate that partner B, if B here is the money partner, or probably because of the risk, that might be the development partner, being willing here itself, we measure the risk faced by each partner, right? We've already calculated IRRs, right? 28% and 16%, whatever they are, right? So we already know the return side of the equation. And how do we measure the risk faced by each partner? So we got half of it. We got half the equation. We got to come up with the other half. Jason. Yes, you did your reading. Nice job. Excellent. All right. So we only need to measure the risk, the relative risk, the ratio of the two risks, or the ratios between the partners. And a simple way to do this is scenario analyses. And the simplest form of scenario analysis is like, it's binomial, right? We have a optimistic scenario above what we think will really happen, and we have a pessimistic scenario below. And what David, the way he frames these scenarios is he says, I want to make these scenarios relatively extreme so that the chance that this would occur would be, they'd be in the final, like 10% tails of a distribution of returns. So these are things that are not likely to happen. And this is a good broad measure of risk, how good or bad things could get. And we can take a look at how the partners would fare if things went really well or really poorly for the venture. Right? That's how we're going to measure risk. So we define the expected return as the base case IRR. We've already done that. We've already got that for each partner, right? And we define the risk as the range between what the partner's optimistic IRR would be and their pessimistic. So that's our measure of risk, right? The difference in return that you'd get as an investor between an optimistic scenario and a pessimistic scenario. That's our range of risk. Deviations of return, that all assumes we've got some robust data series that we can apply statistical principles to. We don't. There's no great data on JV returns, so we're trying to think just more simply. Let's think about risk as how good or badly things could go. Okay? And we'll do this for each partner. And then we will calculate their trainer ratio. So in the numerator, we're going to have the expected IRR, which we've already calculated, but then we're going to subtract the risk-free rate. And that's why David talks about this as a return premium over the risk-free rate, right? So that's return in the numerator, expected return in the numerator, and risk in the denominator, which is that range of expected returns from really good to really bad performance of the venture. All right, so here's our picture of our cash flows. Our question, is this fair? We establish our optimistic scenario. We use 25% higher revenue projections for the rents and the condo prices, all of that. And we put in a growth rate 2% faster than the growth in those revenues over time. I think our base case, we just kind of held them constant. Our pessimistic scenario is sort of the mirror on the downside, although we do include a 5% development cost overrun. And that should disproportionately affect which partner's return? Okay, the managers. All right, so these scenarios based on David's analysis, and he's done, trust me, a lot of analysis, a lot of it with RCA data in terms of returns on properties over cycles. And he believes that for our fact set, these two scenarios would get us into these percentiles in the tails of the distribution of returns, the 10th and the 90th percentiles. Oh, I wish I was left-handed when I use this. All right, come on. All right, so our pessimistic scenario, we get the manager is not going to get all their money back, right? Compound average annual return over our 6-year investment horizon, minus 1%, right? And just a little bit less for the money partner. And that's a function of what? 5% cost overruns being disproportionately allocated to the manager. Here's our optimistic scenario. Wow. 55% return for the manager and 28% for the money partner. All right? So now we've got a nice range for each partner. And this is how we would calculate these trainer ratios, right? The developer would have an expected IRR of 28.7%. That's what we asked. Is that fair? Right? And we'd subtract in the numerator, put that in the numerator, subtract 1% risk-free rate just as a proxy. And then in the denominator, we would look at the range of returns from minus 1% to almost 55%. And that would give us a trainer ratio for the developer of 0.5. Then we do the same thing for the money partner, right? Expected return of 16.8%. Subtract the risk-free rate, that gives us 15.8%. We've got 28.1% range in the denominator, and that gives us a trainer ratio of 0.56. So what does that mean? All right. So the question here is, and here are sort of little table with those calculations. These are similar. Right? They're sort of within 10% of each other, which I think, is sort of good enough for government work, right? We're close. And these would seem to be with approximately equal trainer ratios. We might have one party a little above the line, this or that, but these are basically, this would be, a waterfall like that would be fair, okay? But if you were the, go back, if you were the manager, what would you try to do? Well, first what you try to do is you try to educate your very smart money partner on why this framework is so fair. And then you try to say, well, maybe if we tweak this or that, maybe instead of 60-40, if it was 70-30, over 15%, we could calibrate this and bring it back into equilibrium. And you know what? If you were the money partner and you were looking at something like that, you might try to educate your possibly intelligent development partner, right, on this framework, but neither party may not have much success. This is so far not being used out there in the market. Kier? Absolutely.
One, is there any scenario where you can try to move both parties above the security market? Or is it always zero sum?
It's going to be zero sum. You can't, because if the underlying investment sits on the security market line, means it's fair and from a capital market standpoint, now it's sort of zero sum. We only have we have a fair investment. We have a development opportunity that generates a fair risk-adjusted rate of return, and now the question is how much does each party get of that? So it becomes more zero sum.
And then when you used, when you were picking your estimates for the optimistic range, you haircut it or added 25% either end. Does the ratio hold, like I were to say, at 50 or 50 on either side, or does it matter what the range is?
So if you do not have symmetrical scenarios,
Or just like, do you have to use 25% every time?
no, I think, David, on something like this, in terms of one of the important elements of using this framework is how you define the scenarios. And right now, David has put a kind of a stake in the ground and said, let's try to do something where we end up in the kind of the deciles at the end of the return distribution. It doesn't mean that that's the only way you can do it. Yeah.
What if they're not symmetrical?
If they're not symmetrical, you know what? Email David on that. I don't know. Yeah. Elise?
One of the things you brought up earlier was that the market conditions are constantly changing. So I'm curious to know at what point in the negotiations would you start to calculate these trainer ratios as you're drafting the agreement? Because you're starting to come up with these terms, but the market's changing. Are you recalculating this the day that your lawyers, that everyone's coming to the table? Like, at what point in this negotiation?
First of all, your lawyers would shoot you if you did that, probably. Right? The lawyers would not be happy if you were doing that. But I think when do you calculate these? We have exercised a little bit of tough love with you today. And that is that we didn't give you a term sheet, did we? We gave you an agreement where you had to read every word and react to every word. And so you didn't have the benefit of just having a term sheet. When would this happen? This would happen, these calculations would happen as people are sort of getting down to the basic business terms. So when they execute the term sheet, this is well, lenders really not, the lenders, you're making, at the time that you enter into the term sheet, you're presumably out there negotiating. Maybe you don't have a firm commitment, but you have a good sense of what you can get for permanent financing, and that will fluctuate with the market as you move toward closing. But the deal between the two money partners, that would happen probably at the term sheet stage, and you'd hope, but that doesn't mean, the question was, do we mark everything to market right before we close? Yes?
I would say there's a practical issue for both parties, okay? Unless something really extraordinary happens, you expect that that's set at the term sheet stage, because at that point, effectively, you cut off your negotiations with your other parties, and you've either implicitly or expressly given some period of exclusivity to the money partner. And so the developer is going to say, basically, you come back and you want to change this unless there's been something extraordinary. Get out of my office. I don't want to see you again. And it's the last time we're ever going to talk, because there's an implicit deal at that point. I mean,
Right.
you've got to work out the papers and other things.
And both parties have gone to investment committee, probably, right? So it's like the deal is set, and then the term sheet memorializes the basic business deal, and that's usually when the attorneys kick in earnest. Okay, good question. Yes?
So I get that on this, you're looking at just the two fixed points of 10th and the 90th percentiles of all the market realized returns in the scenarios that you've run. But one of the things that I'm thinking about is the promote structure of any JV deal kind of inherently creates a step-up function in terms of your return.
Yeah.
For both the money manager and the developer. This doesn't really account for that, and it kind of just draws a straight line through the 2 points. How would you really think about that?
Well, it's not, both parties don't step up. One steps up and one steps down in a promoted structure.
So it should be a steep movement between the two, but this one kind of just assumes a straight line of return, linear return between the two. And so that's sort of like where I'm.
So
You
this,
just want to think about like the price point and the expected return point, where the return point would jump exponentially higher for the manager versus for the developer versus the manager.
all right, well, a couple things. I'm not sure if I understand. This linear representation is the market. That's a representation of the market, not your deal. That's the market, the capital market. So, and we did have, we walked through the slides of this particular distribution provision, the structure of this waterfall, and it is a little, it's basically zero sum. It starts out 90-10 pro rata pari passu, and then if things are the profitability is really high, developer gets more at the expense of the money partner. Okay, so.
So if he did, to answer your question, if Edward, if you did a whole lot of different scenarios and you graph the trainer ratios, it would have.
It would be an upward flow there. Okay.
So, and I actually, if David was here, he would. One of the things that that David does in his course, I don't know if you're going to do it this fall, but you do it in capital markets in the spring, is we'll take an example like this, and it's easy enough to do Monte Carlo simulation in Excel, and that's what will generate with 2,000 trials. That's what will generate a complete distribution of returns. Okay, so that's that's one thing, and Excel is very easy to use on that front. Yep.
The security market line, it's a given. It's an assumption that you're given. I don't mind describing how it's determined.
The security market line, it kind of the cleanest would be the easiest depiction. So if you think about a treasury yield curve, right, where what's here, we have expected returns on this axis. We don't have risk on this axis. We actually have maturity. And that yield curve, which often looks like this, is derived by looking at the pricing for the different maturities, right, that are outstanding and trading in the market. And so you can develop a curve. What we're doing here is we're replacing, instead of maturity, we're putting risk. Now the problem is this is very difficult to see in the marketplace, right? So the idea is similar to a yield curve for government security. Well, but you could look at cap rates, but cap rates are at the cap rates at the property level, and it's not a complete measure of return, right? It's just, and on this deal it would be hard because we have condos. So it's different participants in the market agreeing or not agreeing to accept expected returns based on the risk they're taking. The problem is we don't have the kind of robust data that we get from securities prices, or right, either equities or government bonds. So the idea is that that's the concept, that's the construct, but it's not published in any, for equity returns, it's not published in any paper, there's no data. That's
That's what I'm asking. I understand how it works. How do you determine what numbers do you put in to make it slow? You really only have 2 points, am I right? You have a risk-free rate.
You have the risk-free rate, and then you'd say where people start is they look at unlevered returns on assets. So when we looked at this mixed-use project, we said, look, it's different components. Let's talk about fair returns for each of the components, bring them together, and now we have this blend. And it was 11.2%, a little over 11%. And what happens is all the investors out there, all the pension investment managers and the developers, they are all out there competing for sites, right, development sites, and they are determining based on the price they pay for the sites, and if they're using, based on their development program and reasonable assumptions, they, in the back of their mind, knowing what their partners might require, are coming up with what they believe is a fair expected return for the project that will provide each of them a fair risk-adjusted return. So, and that's why we went through, we did it through kind of a survey method called For Smart People. But in terms of what number do you pick, where can you go to do that? If you had, these are people who are sitting on investment committees, seeing lots of deals. They know what their expected returns for their partners are and what they require. Part of it is access to good information. Because there's nothing, I think you probably get the concept, but you're like, take me past the concept. Help me know where I go to get the number. Unfortunately, it's not quite that easy. Yufi?
We're assuming that this property is fair market value given those. But is that where we're drawing the line, saying that this?
We're saying that the when we had the chart up there, which with the expected return for the venture itself, we were saying that in the marketplace that would represent a fair risk-adjusted return. In other words, we could turn around and sell our rights under the P&S. We could get out clean because someone else would be willing to pay the same price for the land. Okay, so that's our assumption. It's sort of fair. We didn't steal it, and we didn't overpay for the land. But it's the land that is what we have to determine what we're willing to pay for the land. Yes, Kier?
Right, wrong, or indifferent. I think last year in Finn, we determined the slope of the SNL, not for real estate, but for other investments, by looking at just an average premium in the stock market over time, and then use that as our slope line up from the risk-free rate. So, I think what you said, using cap rates is the right way to look at it as far as determining an average premium, and using that as your baseline.
The only issue I have with cap rates is it's a partial measure of return. I actually have a huge issue with that, but yeah. Almost done. We have approximately equal trainer ratios. The idea here is we think this might be fair. So how about this? Why don't we now take a look at, this is what we presented in San Francisco. Let's just take a look at in the real world, where do these things shake out? So we had a panel in San Francisco where we had one of our celebrity judges for today, Mark Darley from Grosvenor America, who's done lots of JVs in DC and now is on the West Coast. We had Allison Hill from Prologis, who is the director of strategic capital for Prologis, who does all the Prologis JVs all around the world. We had Amy Price from Bentall Kennedy, who's a chief operating officer, a rich kind of history with Morgan Stanley, who's involved in dozens of joint ventures with Morgan Stanley and with Bentall Kennedy. And who else did we have? And Rob Gifford from AIG Global Real Estate. All right? So what I did is I said, look, I want you to be on the panel, and I'm going to be even more of a pain in the ass, and I'm going to make you submit data where you have calculated the trainer ratios for a couple recent deals. All right? And they all said, all right, we'll do it. And a couple of our students or recent grads were the ones who did it for Grosvenor and for AIG. Allison did her trainer ratios herself, and Amy Price did hers herself. And so that's our hypothetical, right? Where we have the developer manager on the y-axis and our money partner here. And we can see that if both of those, if both had the same trainer ratio, they'd be right on the red line, right? And in this case, we've got a trainer ratio here for the money partner of, what was that, like, that was the 0.56, right? And the development partner was 0.5. So you want the ball to be on your side of the court in this diagram, okay? All right, so condos. Right? This was from Grosvenor. Right? All right? And apartments. From AIG. And office from Bentall Kennedy. And industrial. Well, as Hamid Moghadam would say, well, industrial is really for C students, so sometimes that might happen. All right. So, And, we can look at that and maybe, that's a representation of our 10%, sort of good enough for government work. If we're within 10%, they're fair. And that looks pretty good. But, a lot of investors, you think about risk, they don't worry about hitting a grand slam, right? They don't stay up at night worrying about that. What do they worry about? Downside scenario. So how about if we just use the measure of risk in the denominator as the downside variance from the expected return? All right? Ooh. So that's what this framework superimposed over deals that they've already been done, right? These are deals that they had negotiated and closed in 2015, or probably 2014, 2015. So this was the first time, a month ago, we presented to a big room. We had 600 people in the room. How this framework could work in industry, or how it would look as an industry application. And this is what we ended up with. All right. So that's all we got for you. Yep.
Do you think it will be used in the future?
My personal goal is to jam it down everyone's throat, so that it will be, yeah. We'll see. We'll see how successful we are. We've presented this in New York, London, Boston, San Francisco. We may be going over to Hong Kong to do it. And I think the more people look. How about this? Is it hard to calculate the Trainer ratio? No. So when you bring something up to investment committee, have you already calculated an unlevered return for the asset and a levered return? Have you already calculated what based on your position, manager or investment member, what your expected return is? Okay. So do you do a little bit of scenario analysis, optimistic, pessimistic scenarios? Everyone does that. Everyone already does all the work, right? It's as easy as calculating a cap rate. I hate to say that, but it is. Okay? So do I think people will start looking at this? Yeah, because you'll all go out and say, I'm going to calculate this, and I'm going to go talk to my boss, or maybe the celebrity judges today, and educate them.
What your data says, Todd, okay, is that the developers should use this, okay, not the money partners.
Okay.
Because if you look at your trend, okay, things
You're-
are falling too far on the line.
They're in their court, right? All right.
So yeah, the developers might want to use it, but the money partners, since they're always getting a little bit of an edge, they're not going to be so.
But I thought the money partners were the smart ones, Lee. No? No? All right. So anyway, this is an academic idea using capital markets theory, understanding what developers and money partners really do in terms of calculating expected returns, and then putting it into a framework to try to make a determination whether or not what you've negotiated is fair. And it's kind of an interesting framework. And I think because it's so easy to do, I do think people will start using it. Is anyone using it right now? Let me check my watch. No. But they're going to. All right. So that's all we have for you this morning. What you're now going to do is you're going to get together with your attorneys